Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Retiring today is challenging. It's probably facing retirement for a lot of you is going to be the biggest challenge of your life. If you take a look at the landscape, we're living a lot longer. Interest rates are at all-time lows. You look at the crazy stock market. There's a lot of things that you have to consider to have a successful retirement. Stick around. That's what we're going to talk about today. Welcome to Your Money, Your Wealth. My name is Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I'm with the big man, as always, Big Al Clopine. I think he's sitting right over there. Welcome to the program. There's a lot of things we want to dive into. But here's the first thing, is that are you actually ready for retirement? Do you have the mindset? Are you prepared? That's what's on my mind today.
Probably with nothing else, would like to get onto a motorcycle and travel throughout the United States.
We want to buy a Tesla and a private jet.
I plan on going back to school and earning another master's degree to do my retirement career.
What does retirement hold for you? A recent study for the Transamerica Center for Retirement Studies shows a disconnect between baby boomers' expectations for retirement and how they've prepared in reality.
Most people literally have not put a pen to paper to consider what that's all going to look like.
62% of those surveyed said they are confident they'll be able to retire with a comfortable lifestyle. 44% report they don't expect their standard of living to drop at all. But the reality appears to be a far less rosy picture.
You really have to develop a net worth statement and consider, okay, well, where are my sources of income going to be in retirement? What have I saved so far today? And what do I need to save between here and then to get me to those goals?
Almost half of the people in the survey say they will primarily rely on their savings in retirement. The median amount they've saved is $127,000, but they reported needing $800,000 for a comfortable retirement. The good news is they still have time to do something about it.
The first thing is to take stock of where you're at. And I would say that's the issue that most people confront, is that they sort of have the mentality of wanting to bury their heads in the sand and not confront how much they've saved. And there's no way to construct a game plan to get you to where you want to go and accomplish all of your goals in retirement and have a successful retirement if you don't sit down today to take stock of where you're at right now.
So here's the issue, Al, right? We got lack of savings. People are living a lot longer. We got healthcare costs on the rise. We got inflation. We got all-time low interest rates. And now we have a crazy volatile stock market to kick off 2015. There's a lot of things people got to take a look at.
Yeah, no question, Joe. And I think really to start our discussion, let's talk about 4 critical risks that you need to consider in retirement. The first one, we just talked about it being inflation, and we have not had a lot of inflation lately, but we know it's coming at some point. We know that goods and services will cost more in the future. Another one is longevity. This is good news, bad news. We're living longer, which is great, but that means our money has to last a lot longer. Then we get into interest rate risk. Which simply means as interest rates go up, certain investments will go down. So we want to talk about that. And finally, market risk. I think we understand that the market can go up and go down. We're at or near all-time highs right now, so you need to make sure that you're invested properly. So Joe, it's really kind of these 4 risks, along with coming up with an overall game plan of where you are now, where you need to be in retirement.
Right. I mean, here's the most 4 common, right? If you look at, there's a lot more risks when you take a look at an overall retirement strategy, as we just looked at on that last package, is that there's a lack of savings. First of all, people really don't know where to go, how much money that they should save. But then if you take a look, all right, if I have very little savings, you have to look at inflation. Okay, so if I don't have any savings and if I'm not invested correctly, I'm losing money safely if I'm just sitting, if my money's just sitting in cash. You have to take a look at healthcare issues. You got to take a look at a lot of different things, which we want to dive into the show.
Yeah, no question. So let's start right out with inflation, because right off the bat we know this is a concern. And if you look at in terms of the costs and goods, let's say you have $1, something that costs $1 today, and 10 years from now, at roughly a 3% inflation rate, it will cost the equivalent of $1.35. In 20 years, it's $1.82. And in 30 years, it's $2.46. So it's going to take a lot more income and investments to be able to keep up with inflation. I think we all know this, and this is part of the reason why we know we need to have a certain amount of investments in assets that go up with inflation, like stocks, like real estate, like Treasury inflated protected securities, to name a few. We can't just keep our money safely in the bank as much as we'd like to.
Well, yeah, but I mean, you could take a look at some pundits right now. They're saying, well, there's very little inflation, right? We're almost
Currently.
heading deflation.
Yeah.
So, but if you look at a retirement plan, it's 20, 30 years. I mean,
Right.
people are living a lot longer, so you want to make sure that you're prepared, not only for the next 5 years, you're prepared for the next 10, 15, 20, and 30 years. So you have to come up with the right portfolio to get a certain rate of return to make sure that your money outpaces inflation, and I think more importantly, taxes.
Yeah, absolutely. And then I think another thing really is longevity, in that we are living a lot longer. And if you kind of look at way back in the 1940s and so forth versus right now.
1940s, is that when you were born?
No, actually I was later than that. But here, let's look at this, 1900 to 2009. So if you were born in 1900, your life expectancy was about 50 years or so. And then there was a huge drop there for, I guess, some flu epidemic. But right now, it's closer. We're approaching 80 years. So in other words, we're living a lot longer. I think we know that. It just means that our money has to last that much longer. And when you think about retiring, if you retire, an average age might be 65, although some people are retiring earlier, your money may need to last 25 or even 30 years. This is a lot different than even a generation ago.
Well, here's the most important risk that you have to take a look at, because the longer you live, things are going to happen in your life. You know, you have a higher chance of having health issues, right? So it might be a long-term care stay. You have a longer probability of that you'll go through market crashes. So you want to make sure that you're protected there. So when you look at, all right, well, here, the good news is, yeah, that we're living a lot longer. The bad news is that you have to be prepared. And if the average savings is what, $125,000? That's not going to create a lot of income. You'll go broke in a couple of days. You know, if you take a look at the cost of living here in Southern California, now is the time to get started to figure out exactly what you need to do, identify the risks that you are facing, and make sure that you hedge against them as much as you can.
Yeah, no question. And Joe, I think we have another slide that sort of illustrates the life expectancy, because if you look at in 1941, at birth, your life expectancy was about 62 years. Now, at this point, as a male, it's 76 years plus, female, 81 years. And look what happens as you get older. The life expectancy increases, mainly because you got through some other years. But realize, if you retire at age 55, as a male, 80 years of age, female 83, but then there's another stat that's not even reflected there, which is if a healthy couple, or even a regular couple at age 65.
What's a regular couple?
Yeah, part healthy, part not.
Yeah, so this one spouse is healthy.
Yeah, I blew up on that one.
Right.
But anyway, a normal couple, I'll say whatever normal means to you.
Perfect.
So at age 65, there's over a 50% chance that one of them will live to age 90 or greater.
Right. Yeah, and the older that you get, the longer that you're going to live.
Correct.
And there's probably a 25% chance is that one couple is going to make it to at least age 100. You know, one of the fastest growing demographics is people turning age 100 here in the U.S. And so maybe some of you are thinking, man, I don't know if I want to live to age 100. I'm telling you what, if you're in your 90s and you're in pretty good health, yes, you want to live to age 100, but you want to make sure that you plan for it. A lot of you are going to be in your retirement years longer than your working years. So we just take a look at, all right, well here, if you're going to live that long, right, you have to make sure that you combat inflation. But then when we get back from the break, it's like, well, how do we do this? How do I invest my money? Look at this crazy stock market that we're in, right? And then if you look at interest rates, how do I find the income that I need to generate the income long term? Because interest rates are almost at all-time lows, right? So if I invest in bonds, if interest rates go up, what happens to my bond price, and so on and so forth. We're going to dive into all of this when we get back from the break. So don't go anywhere. Show's called Your Money, It's Your Wealth. Welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson here alongside Mr. Big Al Clopine. How you doing, buddy?
Doing well.
Hey, welcome. We're talking about some investment risks. The market's volatile, and so a lot of times people focus directly on the market, but there's several different things that you have to consider in regards to your overall retirement. Let's go to the true false and see how you did there.
When you start collecting Social Security benefits, you may need to pay taxes on up to 85% of your benefits. And the answer to that question is absolutely true. And the way this works is if you don't make any other income, your Social Security will probably be tax-free, depending upon the level. But if you make any amount of money, say 25, 30, 35,000 or so, then up to 85% of that's taxable. There's another level between 0 and then there's a 50% taxable and then 85% of it's taxable.
Yeah, but some people get confused. It's not an 85% tax. Just 85% of the benefit is going to be subject to ordinary income tax. It'll just show up on your 1040.
Exactly, which is kind of unfair if you think about it, because we've already paid tax on these dollars. But be that as it may, that's our rules as we have them.
That was under OBRA, Omnibus Budget Reconciliation Act.
Wow, you're the computer.
Yeah, that's right. So what? I think we got something fun to kind of lighten up the mood a little bit.
I think so, because we're talking too serious. Let's have some fun.
So when you retire, that's what you don't necessarily want to have happen.
Well, and
they're playing with the. I mean, that's babysitting with the grandkids right there. That's a hip replacement waiting to happen.
It is, and we can laugh. I can laugh about this because I'm a baby boomer. I mean, this is me in a couple years, right?
Yeah, playing with the grandkids, right?
Maybe tonight.
Yeah, get on the slide, do a little jump rope, a little skateboarding. Oh, boy.
Anyway, let's switch this over to get back to our content, which is we're talking about the 4 risks. And the next one we want to talk about is interest rate risk, which many of you may not know about. This is the risk that an investment will lose value based upon a change in interest rates. And as interest rates go up and down, certain investments go up and down as well. So, Joe, why don't you go over that? Because I think this is an important fact that a lot of people don't know.
Right. So when you look at, let's say, bonds, for instance, you can absolutely lose money in a bond. And so when you figure out, all right, what is my allocation? How much money do I want to subject to risk when it comes to stock market risk, and how much do I want to keep safe? But here's the deal. With interest rates as low as they are, a lot of you could be in jeopardy of losing a lot of money in your bonds or fixed income. Because if you look at rate, okay, as the interest rate increases, your bond price will go down in value. And the reason for that is really simple. Let's just use a quick example. $100,000, okay? Let's say that you give an organization $100,000. That's just a loan to that organization. In return, they will pay you an interest rate. Let's just assume 5%. So they will pay you $5,000 per year of income. So you gave them $100,000, they're giving you $5,000. Now, let's say next year, interest rates spike up to 7%. Okay? Now, you will always get that 5% interest or that $5,000. How you lose money in a bond is that if you have to liquidate the bond prior to maturity. So if it's a 30-year bond, you will get that $5,000 for the next 30 years. However, let's say interest rates, like I said, go up to 7%, but now you need to liquidate the bond. You need that capital. You need that $100,000 back from that organization. That company is not going to give you the money back because they don't have it. They used it to increase the bottom line. They might have hired a new CEO or a new CFO or built infrastructure, whatever the case may be. So you will have to sell that bond on a secondary market. If interest rates are now 7%, so another individual could take $100,000, give it to a similar organization, and now get $7,000 of income versus 5. So if you're trying to sell your bond and say, hey, I have this great investment, it's paying me 5%, no one will buy it because they can go across the street and get $7,000 of income. So what do you need to do? You need to entice that investor to purchase your bond. And what does that mean? You have to discount the price. You have to discount the price. And you might have to say, hey, how about $80,000? Now that makes sense. They will give you $80,000. You had to take a discount. Okay, now that other investor would get the $5,000. So they're foregoing the $7,000 of income. They're getting the $5,000, but they bought the bond at $80,000. They bought it at a discount. So be careful here. As interest rates go up, these bond prices will get crushed. If you look at the 10-year Treasury right now, it is rock bottom, 2%. So interest rates can only go one way, in my opinion. They have to go up. We just don't know when. Okay, so as interest rates climb up, be very careful. That is interest rate risk. Because if you take a look, depending on the term of the bond, you want to stay very short. The longer you go, the more sensitivity this is. Because if you think about it, right, I'm trying to sell the bond. Well, that other individual has to hold it for, let's say, another 20, 30 years. That's a lot of risk. So you want to stay shorter on your bonds, okay? And then that will help hedge against some of this risk. Al, it gets a little bit complicated when it comes to some of these investments, but I think if you look at interest rates right now, people will get burned. I think a lot of people will lose money in their bonds because they don't understand how it works.
Well, they will, Joe, and I think you said this rather well, that you have to be careful with your bonds right now. So we're not saying to sell all your bonds, because you need bonds. That's safety in your portfolio. But you want to, at this point, you want to have high quality bonds, which means government bonds or maybe high quality corporate bonds, and you want to stay very short term, because as interest rates go up, and they eventually will go up, then the shorter term bonds are not affected near as much. And that leads us maybe to our next risk, which is market risk, which is the stock market. I think we all understand the stock market goes up and it goes down. But then the real question is, all right, so I know I need to have some bonds for safety, and I know now that I need to have short-term bonds because of this interest rate risk and high quality, but how much should I have in bonds versus stocks? And Joe, why don't you go over that?
Here's the dilemma. It's like, okay, well, if I invest in bonds, interest rates are at all-time lows. If I go long, I might get a decent rate of return, but I'm taking on a lot of risk there. Well, if I go into stocks, well, stocks are volatile. I can lose money there. So where the heck do I go? Where do I find that safe haven? Well, you need a diversified portfolio, and it always basically starts out with your goals. So let's look at here. So if I want to, let's say $70,000 is my spending. That's what I want to spend on an annual basis from now until the end of life. So then I have to look, all right, well, my Social Security is bringing in $30,000, so I take $70,000 minus the 30, okay? Then I have some pensions and other income, take another $10,000 away from that. $30,000, okay, is my shortfall. That's the number that you have to get to, okay? All you have to do is a simple exercise, and you will find out exactly how much capital that you need to maintain a lifestyle of your wishes. Here's what you do. You find your shortfall, you multiply it by 25, that gives you a big fat number of $750,000. If this is your goals, this is what you need. Now the question is, all right, well, out of this $750, maybe I saved it. How much money do I need in stocks versus bonds out of the $750? Well, it gets a little complicated, but let's say $30,000 is my shortfall. Here's what we do. Here's a real simple rule. You just multiply this now by 10 because I want 10 years. Okay, 10 years of very safe money, because I don't care what happens in the stock market over the next 10 years. Don't worry about it day by day, because over a 10-year period, you know if you have a globally diversified portfolio, the probability of that being higher in value is very, very high. So now I need $300,000. See this? It doesn't work. 300. Yeah, that's a lot of money. This whole screen doesn't like it. You need $300,000, $300K in bonds. So if you look at $750,000 is the total nest egg, you want at least $300,000 of the $750 in bonds. If you look at a percentage, that would be a 60-40 split. 60% stocks, 40% bonds. That will tell you exactly what you should do in real simple kind of Sesame Street type numbers there. All right, hey, when we get back from the break, we're going to answer your email questions. There's a lot of coming in, and then we'll see where the show takes us. So don't go anywhere. The show's called Your Money, and it's Your Wealth.
I'm using the money that's in the 401k to buy and sell properties. So I'm wondering, from their perspective, is that the best way to handle that from a tax perspective?
Hey, welcome back to the program. Joe Anderson, Big Al Clopine, Your Money, Your Wealth. Great question. A lot of individuals want to use their retirement assets to purchase real estate. A couple of different ways to do it. You can buy a real estate investment trust, traded or non-traded. But I think she's referring to, Al, as a hard asset, like buying a single family resident or maybe an apartment building or a triple net lease or tenant in common or whatever it is. Al's been a real estate investor for how long, my friend?
Probably almost 30 years, I would say. And so there's really two ways to do this. If you want to buy property, one is actually inside a retirement account. So you'd have to take that 401k, you'd have to roll it to a self-directed IRA that allowed real estate. and you can actually purchase real estate within your own self-directed IRA. It's not necessarily what I would recommend, though, because real estate is one of the most tax-favored investments there is in terms of a lot of the income is tax-free because of depreciation. If you sell the property, you get a capital gain, which is a lower tax rate. You can do a 1031 exchange and pay no tax, and when you pass away, the kids get a step up in basis and they don't pay any tax. When you have your real estate inside a self-directed IRA, none of those things are true. All profits are taxed at the highest tax rate. So we don't really recommend that. The second way is you can distribute money and buy real estate as you do regularly. The problem with that is you have to pay taxes on what you distribute.
Yeah, that would be not a very good idea. So you got 401k dollars, so you're taking the dollars out of the 401k to purchase real estate. Well, if you're under 59.5, it's a 10% penalty plus ordinary income tax. So that's the last thing you potentially want to do is you're taking an investment inside of a shell of a 401k plan, taking a distribution, paying the taxes, potentially penalties, and then going purchasing another asset. Like Al said, it would make more sense to roll the money out into a self-directed IRA, and then you can purchase just about any asset that you'd like except for collectibles in life insurance. So that's the answer. Hopefully that helps. Let's go to the true-false question.
I can avoid current taxation by rolling over my 401k to an IRA. And the answer to that is true. That's actually a pretty simple thing, and a lot of people don't know that. You can take the 401k, you can roll it into an IRA, and you don't pay any tax. And the way that you want to do it these days is a direct trustee-to-trustee transfer. And then there's no tax to pay. Now the money's sitting in an IRA. When you withdraw it from the IRA, of course, it's taxable, and it's subject to required distributions.
Be careful here, though, because now that there's new rollover rules. So when you are taking money from your 401k plan, you want to make sure that it is a direct rollover, all right? So then that, let's say if my money's at Fidelity, through my employer, I retire, separate from service, I fill out the paperwork, make sure you put direct rollover. All right, and then what they do is that they will send you the check, but they won't put it in your name. They'll put it in the name of the new custodian. Let's say if you want to move your money to Vanguard, into an IRA over at Vanguard, TD Ameritrade, Charles Schwab, whatever. So they'll make it out to that custodian for the benefit. For instance, if I retired and I said, here, I want to do a direct rollover, I would get a check in the name of Vanguard for the benefit of Joe Anderson. Then I take that check and deposit into my account. There's a new rollover rule, too, that we talked about in a previous show that just came into law this year, so be careful. There's a rollover. That's a 60-day rollover that you can take money out of your retirement account, and you have 60 days to put it back in. That's only a one-time shot. Before, you could do it from several different accounts, several different custodians. Not anymore. The rule changed. You have one time to do it. So a rollover is just taking money from your IRA as like an interest-free loan and then paying it back. I know these words are cumbersome, so you have to be extremely careful. We're going to see a lot of money get taken away from the IRS unnecessarily because there's so many different terminology that you just want to make sure that you're careful. Let's go to a quick email question.
All right, I'm 57 and my employer is offering me a generous early retirement package. Can I withdraw funds from my IRA or 401k before 59 and a half and avoid the early withdrawal penalty? This is from Peter in Escondido. And the answer to that question is yes. There's a couple ways you can do this. First of all, the 401k, once you retire and you're over 55 years of age, you can pull that money out without that 10% penalty. As far as your IRAs go, you got to wait till 59 and a half unless you elect what's called a 72T election. That means you take a series of periodic payments over time. You will pay the tax on those dollars, but you can avoid penalty from that.
Yeah, it's a separate equal periodic payment, SEPP, so you have to take the same amount of money out of the account, all right, for 5 years or until you turn 59 and a half, whichever is longer. So if you are looking at an early retirement, you can take the money out at 55, or you can distribute the assets, like Al said, using the 72T tax election. I think we got time for one quick one, Al.
All right. My plan is to retire in New Zealand in 2 years. Will I still need to pay taxes in the United States even while I'm living in New Zealand? This is from Martin in Mission Viejo. The answer to that question is yes. And the way this works, as long as you're a U.S. citizen, you have to pay taxes in the United States. You will pay taxes in New Zealand, but you get a credit in the United States for New Zealand taxes.
New Zealand. Have you ever been, Al?
I have not, but it's on my wish list.
It is. Yeah. Well,
one of my sons and my wife has been there, but not me.
So yes, a little foreign tax credit, I think, is what you were referring to.
Correct.
Wow, Big Al, you can't get any smarter than that. I think we're going to come up with a segment called Stump Big Al.
It's never going to happen.
Well, hey, that's it. That's it for us today. Hopefully you enjoyed the program. We'll be back again real soon. For Big Al Clopine, I'm Joe Anderson, and you just watched Your Money, Your Wealth. Have a great day.